Hello everyone and welcome to Osiris New Zealand risk model. So on behalf of the MT4 coding team, we're going to take a time to show you exactly how it works and the most valuable lessons that we have learned in the last 15 months using Osiris. Everything you will see now is automated. We haven't used our hedge or trending strategies to balance the equation. The reason why we're doing this is because we just want to say, what if we don't touch anything? I mean, after all, that's the main purpose of automated trading, isn't it? So, as usual, remember that past performance does not indicate future performance. We're gonna show you exactly how it works. Today, just for recording purposes, today is Saturday, 21st October 2017. My name is Jose Ricardo Tejaen. I'm designer and co-founder of Osiris in the different modules, and let's go ahead and show you exactly how it works. And as I said, we're gonna cover only on this video the New Zealand dollar risk model. Basically, we have right now 5 that have been somehow successful, and that's for you to judge. Members will get more information about our hedge strategies, and also you get the newest trending module that we have designed coming from Osiris Ragnarok. The main idea is that the way we build every model is using 7 currencies. So we're going to jump directly, go to our not the MT4, the MyFX book version. Remember, all the information we're using here is collecting to give us an idea in the now how exactly will look. Now let's start with the gain so far. We have 15 months of data with a 50.25%, and that's a 16.75. Just let me double check. We'll do the math for you. If you take the gain 50.25 divided 16.75, that will give you a figure. I just have to update it here. It should be 3. This number means, if you want to translate it that way, that for every dollar you're risking, you will be taking home $3. That's absolutely a tremendous return, very positive return. Thinking that with the hypothetical 50,000 here equity, you only experience 16.75%. Actually, now we're going to take a look at the drawdown. I'm going to switch to profit, and you can see here the very steady progress of the drawdown. And right here, March 7, almost $8,000 in drawdown. But before that, it was very not too far from the minus 5,000 range. Very good. Also here you can see the very balanced growth of the equity curve. Now let's move to the summary section so we can see exactly here. This is what we have. On this model, what we're doing, we're adding the cross euro versus the Great British pound, just as we wanted to collect the data on this currency, as we don't have any data right now. And here we have the 10 months in the year, and here are the risk reward ratios. I want to focus your attention on the risk reward results. Look at this: 6.89, 8.44, and that's the key for your success in the trading business. As in any business, you have to maximize your risk reward. At least if we go back to, in a way, quoting one of the greatest of all time, Paul Tudor Jones, to be successful, 5 to 1. For every dollar you risk, you have to get in return at least $5. Let's go back to 2016. 1, 2, 3, 15 months. We're going to November, and that will be really good. Let's take a look here a little bit more. 697, 705, very strong. Look at this one. Cross New Zealand dollar versus Japanese yen, 1102. Wow, that's a very powerful risk reward. And so far that has been making this trading model, risk model, very successful. Let's go over now back to 2017 and just give you a benchmark in how you should pay attention to say if it's worth or not. We're not adding to our wide range of tools a benchmark that is public information. We have the Barclay, which has nothing to do with the Barclays Bank in London, and this is an index fund based on currencies. Just to give you an idea, right now yield today is minus 10%, almost minus 11%. This is a world-class index, currency index, that you can use to evaluate your performance. And think about it, let's say a 12-month versus an estimated, if we just have to take the year now, if we just have to say the year, let's say we have almost $6,000 in profit for the year. Put it in a way, 8.51%, and the drawdown is we take it here, just look at it, almost $8,000. So you have in a way $8,000 in drawdown on a hypothetical 50,000. You can always adjust that to give you an idea. In this case, what we'll say on retail trading, the bare minimum to start this will be $20,000, and that will give you pretty much a 45% drawdown, and you will have close 50, probably 25% return. Not the best combination of risk reward, but still will put you in a position that is positive and way positive above what one of the most important indexes is doing out there. Also, I want to close this. I'll give you an idea. Let's say we use also the S&P 500 as a benchmark. If we take the return from January 1st, 2005 to December 31st, 2016, adjusted for inflation, including dividends, and you calculate that, you will get as an annualized return a 5.35%. That's an annualized return. Now, of course, during that period, you will see that, for example, after in 2013, you see the big return, but that was just coming out of the credit crunch. Now, if I were to take full spectrum from the 2000s up today, you will see that your annualized return will be much lower, 2.27. So after all, what we have here, hypothetically speaking, for you will be a very decent investment. Thank you so much, and keep watching for more information about Osiris.